Hey, welcome. Today we are diving deep into equities. But forget the complicated charts and jargon for a minute. We're going to talk about what it actually means to be a part owner of a business. Ready? Let's jump right in.
So have you ever looked at a company you really believe in and just thought, man, I wish I could be a part of that? You know, to get in on the ground floor, to share in their success? Well, that's exactly what we're talking about today. That idea is the whole point of the stock market.
All right, so let's start at the very beginning. Before we even get to markets or trading, we need to understand the fundamental building block of it all, the share. What is it, really?
At its heart, a share is basically your receipt. It's proof, usually digital these days, of course, that you pitched in some of the money a company needed to get off the ground or to expand. And in return for your cash, you get a claim on that company's future. You literally become a part owner.
And you know, the name itself couldn't be more perfect. When a new company needs money, a bunch of investors get together and each contributes their share of the total amount. So you're not just buying some abstract financial thing, you are buying a literal piece of the company's foundation. It's a pretty powerful idea when you think about it.
Now, the most common type you'll hear about are ordinary shares. Some people call them common stock. Think of these as the backbone of the company. As an ordinary shareholder, you're providing what's called risk capital. And that's a key phrase. It means you're taking the biggest gamble. If things go south and the company shuts down, you're the last in line to get paid. But, and it's a big but, for taking on that risk, you get the biggest potential upside. A slice of the profits called dividends and the power to vote on how the company is run.
Okay, so this brings us to a really important point. Not all shares and not all owners are the same. As an investor, you actually have to decide what kind of owner you want to be. And this is where we hit a crossroads.
This is your first big decision. It's like a fork in the road. Are you somebody who's chasing growth and wants to have a say in the company, even if that means taking on more risk? Or are you looking for more stability, a more predictable income stream? Your answer to that question will point you down one of two very different paths.
And here's that choice laid out side by side. On the left, you've got your ordinary shares. That's the path with voting rights and huge potential for growth, but it comes with higher risk and dividends that can go up or down. On the right, you have preference shares. With these, you usually give up your right to vote and some of that explosive growth potential, but in exchange, you get a fixed, steady dividend and you're first in line to get paid. It's that classic trade-off, risk versus reward.
So let's talk a little more about those preference shares, because they're a really interesting beast. They're not quite like ordinary shares, but they're not alone either. They're kind of in between, and that's why they have a special nickname.
They're often called a hybrid security. Now, that sounds super technical, I know, but all it really means is that they borrow features from two different financial worlds, the world of ownership, which is called equity, and the world of lending, which is called debt. Let's break down exactly what that means.
So here's how it works. On one hand, they're like equity because they represent ownership in the company, and they pay out dividends from profits. Simple enough. But on the other hand, they act a bit like debt because they usually come with a promise of a fixed payment, like an interest payment on a loan. And you get paid before the ordinary shareholders even see a dime. It's this unique mix that makes them a hybrid.
And just to make it more interesting, it doesn't stop there. Preference shares come in different flavors. For instance, cumulative shares mean that if the company has a bad year and can't pay your dividend, they still owe it to you. It accumulates. Convertible shares are cool because they give you the option to swap them for ordinary shares down the line if you want to. Each of these little features just adds another layer to that whole risk and reward decision.
So whether you go down the ordinary path or the preference path, becoming an owner isn't just a title, it comes with some very real, very tangible benefits. And that brings us to the payoff, your actual rights as a shareholder.
See, owning a share isn't a passive thing. It actually grants you specific, pretty powerful rights. It really boils down to three key rights that define what it means to be a part owner.
Okay, right number one is the one everybody knows about, dividends. This is your cut of the profits. If the company has a great year and the board of directors agrees, they'll distribute some of those earnings back to you, the owners. But, and listen, this is a huge but for ordinary shareholders. It is never a guarantee. The company might decide it's better to reinvest that money back into the business to fuel more growth. Next up is something called preemption rights, and this is a super important protection for you as an investor. Just imagine you own, say, 10% of a company. If that company decides it wants to sell a bunch of new shares to raise more money, it can't just ignore you. It has to offer you the chance to buy 10% of those new shares first so you can keep your ownership stake at 10%. It stops your piece of the pie from getting smaller.
Let's look at the numbers. It makes it really clear.
Say you own 20,000 shares out of a total of 100,000. That means you own 20% of the company. Now, the company wants to issue 50,000 brand new shares. Because of your preemption rights, they have to offer you first dibs on 20% of that new issue, which is 10,000 shares. If you buy them, you now have 30,000 shares out of a new grand total of 150,000. And what's 30,000 divided by 150,000? You guessed it, still exactly 20%. Your ownership stake is totally protected.
And finally, we have the right that really makes you feel like an owner, the right to vote. For ordinary shareholders, the rule of thumb is simple. 1 share equals 1 vote. This gives you a direct voice. It gives you a say in the major decisions that will shape the future of the company you've invested in.
And what are we voting on here? We're not talking about small stuff. You get to vote on who gets to be on the board of directors, the people literally steering the ship. You get to approve or reject those dividend payments we talked about. You get a say on all sorts of key company matters. This is real influence.
So when you put everything together, the potential income you can get from dividends, plus the potential for the value of your shares themselves to go up, which is called capital growth, you get something called total return. And that is the name of the game. It's the reward for providing that crucial risk capital in the first place.
So being a shareholder is all about making a choice. It's about balancing risk and reward, deciding if you want income or control. So that leaves us with one last question to think about. Now that you know the difference, which path offers the right rewards for you? What kind of owner would you want to be?